a lot of times the movement of the Fed is kind of based on projections of economic activity, or sometimes a slow, slow what's happening with economic productivity, especially in the case of inflation that's gotten up there as it did this time around. So I guess that's the other issue here. If they start cutting, does that mean that the projection of economic activity is, oh, things are going to be getting worse and we're trying to stave this off, and recession, there's all the talk about the hard landing versus the soft landing. So is rates coming down a good thing for the economy, or is it, hey, there's trouble and it needs help?
Okay, so there's 2 points there. The first point is normally rates coming down in a longer term picture is good for the economy. It stimulates business demand and capital spending, and it's very good for housing. And remember, housing is roughly, over 10% of the US economy. So in the big picture, rates falling is stimulative to the US economy. Now, if we talk about the way a rate cycle normally works, is that the economy is growing, it's growing too fast. The Fed raises rates to try to slow that growth down. Historically, they raise them too much. Then what happens is the economy starts to slow, oftentimes pretty rapidly, and then the Fed cuts rates. Normally, when the Fed is first cutting rates, that is actually a little bit of a negative, because as you mentioned a minute ago, oftentimes the reason they're cutting rates is because the economy is rolling over. So initially, historically, with regard to stock performance, when the Fed cuts, that's actually usually a short-term negative signal for stocks. However, if you go out a little ways, it's actually a positive signal. The Fed is always able to engineer the recovery of the economy by bringing rates down. And so when you're at the beginning of an easing cycle, there may be a little pain up front, but historically, that usually means good things for stocks farther out. I hope the way I said that was clear.
Yeah, and so maybe to illustrate it, we can bring up we had our colleague Kenley Scott. He diagrammed really over history a number of times when the rates were cut and what happened in the market, and so we probably can bring that up here in a second. And so yeah, Randy, you can take a look at this and maybe walk us through this. And so for those of you who are listening to the podcast, you can always go to investors.com/podcast and see some of these charts that we're pulling up. So Randy, so maybe walk us through this, and this is really starting with. Go ahead.
So on this chart, the gray line is the stock market, okay, and then the blue line is the Fed raising, and the pink line is them cutting. And you can see a lot of times when they first cut, the market goes down because the market's realized we're in an economic slowdown, okay? But then over time, that actually, the market bottoms out, and with lower rates, it starts to do much better. Now, one thing that's a little bit different this time around is this slowdown has been so anticipated. We've been talking about it now for a year and a half, that it's a little bit of a different scenario. And I'm not sure we're going to have the same effect with regards to stocks from the Fed lowering rates. The bond market has had a huge move. Bond yields peaked intraday on the 10-year on October 23rd at over 5%. We closed today on the 20th with rates on the 10-year under 4%. So bond yields at the 10-year time horizon have actually fallen over 20% in less than 2 months. So I actually think that's bullish for stocks. It's bullish for risk assets. And we've seen that. And that's what's really one of the big contributing factors that's led to this very strong end of the year rally.
And a lot of people have been, for a while now, talking about that inverted yield curve. The inverted yield curve that almost always, has a recession, coming behind it. And the inversion's a little bit less now with that 10-year coming down as much as it did, and some of the shorter term ones maybe coming on the way too, in anticipation of what the Fed is doing. But is that still something that you think is an indicator that's worth looking at, that inverted yield curve, and what that means for a potential recession?
I think it is an indicator that matters. It's got a pretty good track record of forecasting slowdowns. Normally, the way the curve resolves its inversion is the economy does slow down and then the short end of the curve collapses. So the way it normally uninverts is not with the long end going up, it's with the short end falling a lot. Okay? And especially at the beginning of these rate cutting cycles like we're looking at on the screen. Now, the inversion is about 50 bips, which is historically not a great level for stocks. But we're in a kind of an unusual time, and it's a very different cycle. And we'll see, we'll kind of see what happens. I think the most important economic metric to monitor is employment. And what we've really seen over the last year is that in America, if someone has a job, they're spending money. So the reason the economy has been able to hang in there is because, despite things like a slowdown in housing, et cetera, is because employment has remained so good. And this most recent couple of months, employment went up to 3.9, but last month it came down to 3.7. So unemployment is still very, very low. And if it remains low, it's likely that the economy is going to be okay. And I think this is what the market's counting on for hopefully a soft landing next year.
So maybe Randy, talk about, because it's been a really interesting year, obviously, for most of the year, the Mag 7 was dominating the environment. But with the Fed pivoting and getting more dovish, we started to see the Russell 2000 start to participate more. We started to see more participation and broadening of the rally. Maybe talk about kind of maybe that potential transition into more of a broad-based market.
The large cap tech stocks, the mega cap, the Magnificent Seven, are really essentially defensive stocks because they've got a very high likelihood of success. Their earnings stream is pretty stable relative to small companies. Small companies have a couple of factors. First is their balance sheets are not as good as these huge mega cap tech stocks. As a result, when the Fed is raising rates, that puts pressure on the small cap stocks in terms of their ability to raise capital. When the Fed is lowering rates, it makes the capital environment easier. So that's very good for small cap. The other thing is that small cap stocks are much more levered to the US economy than the large cap. Large caps get a big percentage of their sales from overseas. Small caps in general are almost entirely domestic. And so they're very focused on the US economy. So now that people are starting to believe we could have a soft landing, that's actually very bullish for small cap stocks. Small stocks have lagged large cap stocks greatly over the last 2 years. And if you look at the market now, the S&P, the NASDAQ, and the Dow are either at new highs or flirting with new highs. Whereas the Russell is still more than 20% away from a new high. So if we have turned the corner on small cap stocks, there's still a long way to go in this cycle.
You kind of bring up some of the differences between these, multinational companies, especially the Magnificent Seven, and the smaller companies. Should we get a little bit of the discussion of the dollar in here? Because certainly, whenever you get a strong dollar, you start hearing the multinationals start talking about forex exchanges, and what that does to their earnings and revenues when they do those foreign currency exchanges. Is that something that's part of the equation here, or is that really kind of secondary? Because
it's part of the equation. Listen, the Fed is the bank to the world, essentially, right? It's the biggest, most important central bank. When the
reserve
Fed
currency
begins,
and all.
when the Fed begins an easing cycle, it affects everyone globally. When the Fed is tightening, you should think about interest rates as a bribe to have someone hold your currency, okay? When the Fed is raising rates, the dollar is rising, as it has this last year. And that has a couple of effects. One, it normally puts a lot of pressure on emerging markets. And next, it hurts corporate earnings because there's a negative currency translation, especially for large caps, as they translate the profits overseas back home into dollars. When the Fed is easing, that's good for emerging markets. That usually lowers the dollar. And in fact, the dollar has come off of recent highs. It's trading about 101, 102 versus the basket right now. Earlier in the year, it was more like 104, 105. Okay. Mm-hmm. So we have seen the dollar give up some gains relative to foreign currencies. We've also seen, as the dollar comes down, that's stimulative for the emerging market indexes. So the dollar does matter. It matters more to large cap than small cap because, again, the small caps are not getting a huge percentage of their sales overseas in general. Obviously, there are some small cap companies that get a lot of their sales overseas, but in general, the Russell 2000 gets a smaller percentage of its sales overseas than the S&P 500. I think the S&P 500 gets something like more than 25% of their revenues, if I remember correctly. Mm-hmm. So the dollar translation effect has a much bigger impact on large cap. Now, as the dollar comes down, that's actually a positive to help earnings for 2024. So if you think we're going to have a weakening dollar next year, that actually should increase your confidence a little bit of the ability to hit the earnings targets for large cap.
What should investors really be thinking of? Again, it's the overall theme, of course, this is said over and over, don't fight the Fed. We've really kind of had a very unusual time period because certainly with COVID and so much stimulative effects, not just from the Fed, but of course from legislation and the stimulus checks, everything that was happening on the stimulative side, and then supply chains getting disrupted, everything that kind of led to the inflation side. What can we kind of gain from this historically, since this is a little bit unprecedented? But what should people be looking at in terms of the correlations with past events that have happened with the Fed?
So a few things. One, interest rate movements, interest rate changes by the Fed are like potato chips. They rarely can have just one, whether it's a hike or a cut. Okay. Yeah. So if the Fed is entering a new cycle where they're going to start cutting rates, then that means there's probably going to be a few of them. Mm-hmm. That's the first thing. The second thing is, I guess there's three things I want to say. The second thing is, I feel that we have likely seen the highs in bond yields for this cycle. I do think we are now in a permanent higher trading range of inflation and interest rates than we were over the last 10 years. Okay. Mm-hmm. So we're not going back to 75 basis points on the 10-year. Okay. The new range is higher. So maybe the new range is, I don't know what it is. Maybe the new range is 3 to 5 or 250 to 5 or something like that. Mm-hmm. So that means for fixed income investors and for individuals, this is probably a good time to extend duration in your fixed income portfolio. Mm-hmm. Now you kind of missed the high, but if the Fed is going to be cutting next year, those rates are going to be coming down. So this might be a good time to take some of that money you have in money markets and extend it out, 2, 3, 5 years. So that's kind of the next point. And then the final point is, oftentimes in these cycles, the declines in inflation are not linear. So there's an awful lot of good news in the stock market. There's an awful lot of good news in the bond market. It would not be beyond the realm of possibility to get an inflation print in the first half of the year that goes the other way. Now, that doesn't mean a trend change, but it just means you're not going to be, every print doesn't have to be perfectly in line. And if that happens, that could really upset financial markets in the short term, given how much we've run. I mean, the market is very, I don't want to give a mixed message. The market is very overbought in the short term, both in fixed income and in stocks. Now, do I think the fact the Fed is turning its cycle is bullish for financial assets? I do. Do I think next year can still be a positive year? I do. But we've had a huge move in a very short period of time, and it would not be unusual for us to give some of that back.